Hello, I'm Karen Coleman here on KCWTV. Thank you for joining us today. Well, the state of the Irish economy doesn't seem to be getting any better. In fact, sometimes it seems like it's facing a permanent journey of decline. Today, the International Monetary Fund, the IMF, announced that the Irish government wouldn't meet its deficit target for this year. And that followed news that Allied Irish Banks is to shed 2,000 jobs after posting a record net loss of €10.4 billion on its continuing operations for last year. Well, earlier I was joined in studio by two men who've been commentating regularly on the state of the Irish economy. Donal Donovan worked for the IMF for nearly 30 years. He was a deputy director there when he retired. And Peter Mathews, who's now a Gael TD for the Dublin South constituency, regularly commentates on the state of the Irish economy. Here's what they had to say.
Well, let's turn to the 160 billion owed to the European Central Bank, because I think that is really a huge elephant in the room here. And they lent that money in order to finance basically the withdrawal of deposits from Irish banks.
And to redeem 60 billion of bonds, which is lost.
I was in the middle of the sentence. Both to finance the withdrawal of deposits and to finance the redemption
which
of
was
bonds.
the wrong thing to do.
Now, they did that because otherwise the banks wouldn't have been able to make these payments, and there would have been, in some sort of sense,
which would have forced the restructuring, though, wouldn't it? Yeah.
It would have led in the first instance to a non-payment, semi-default, can't pay situation. Now, what would have happened after that is
but
debatable.
The state at least wouldn't have been involved.
Correct. The state would not have been involved, but the banks arguably would have closed the doors, some or other of them, and have, in some form or another,
they would have been
defaulted.
And the bill would have been divided out correctly.
This is a scenario in which one can talk about could we have had a run on the Irish banks, or closure of Irish banks, AIB or BONI. But anyway, that didn't happen, and the ECB has been keeping the Irish banks afloat on drip for the last year and a half. We now have 160 billion, and this is to use Peter's phrase, a fact. Whether it should be there or not is arguable. It is there. Now, I think we have a difficult problem here, because the European Central Bank would like its money back. A large part of its balance sheet is now out to Ireland.
Yes.
Ireland is only
1%.
Part,
actually, Donal.
Very big part.
And that's why they came here on the 29th of November.
That's
the only reason, because they thought they had a bad debt.
1%
of... But what you're saying, Peter, is we actually can't repay...
Well, let me say what I think will happen.
It is the argument. It's not mine. Don't own it.
The ECB has a certain amount of collateral, because people don't lend money without collateral these days. And they have two forms of collateral. They have NAMA bonds. I don't want to get into the technical nature of that. I also have some government bonds, Irish government pieces of paper. And they also have claims on various assets that the banks, offered, property, mortgages, whatever other financial securities. We do not know whether, if these assets were marked to market, that is to say, you look at their current value today, what might be the losses. But the ECB is concerned about this, because they're, like everybody else in the world, is concerned about their own financial position. And the European Central Bank is owned by the 17, effectively owned by the 17 euro member
countries. It's a bit like a European IMF.
It is.
Yes.
And you see, Ireland only has 1% share of this, whereas Germany has, I'm not sure, 20, 30%.
Hence they're very concerned.
So if if there were losses in the European Central Bank, 20, 30%, say arising from losses on the loans to Ireland or to Portugal or Greece or to whoever, 30% of those losses would immediately be reflected, and that's a large sum of money, say, in the German Central Bank and the German taxpayer.
Because
whereas only 1% of it is going to fall on us.
The German Central Bank will lend to the European Central Bank.
Exactly. The German Central Bank is a shareholder in the Irish. The European Central Bank is composed of the individual individual central banks, and each of the national central bank is a shareholder in the capital.
But isn't it the case, though, Donal, that the money that the ECB lent to the Irish Central Bank and to the banks it's supposed to be an overdraft facility, but it turned into kind of a long-term loan.
This is
we're stuck with it, Karen, because it's like say you or I borrowed 5 million and it's an overdraft, and then they say we'll convert it into a 5-year loan. It makes no difference. I can't pay it back.
The problem,
my salary will never pay back 5 million.
Central banks are not supposed to do this kind of thing.
And why did they do it?
They panicked. they were not willing to go, and I'm not saying they're wrong, by the way, but they were not willing to go the other route that Peter has described, let the banks fail. They would have been under substantial pressure from the Irish government not to allow this to happen.
Before the bank guarantee?
After.
Then all after the bank guarantee?
After.
Karen,
And it really became very, very strong about a year ago, because what happened was the guarantee was going to stop. People still had deposits in Irish banks. They reckoned that once the government guarantee stopped, they were on their own. So they rushed to take the money out. And this was very serious in August, September and October last year.
But Donal,
and by the way, that's what precipitated the bailout, because the ECB were getting so far into this. They said, my God, we have to have somebody...
money was leaving these banks.
Money was leaving the banks in droves. And the bonds. The bonds were all being retained.
Donal, here's something that people aren't aware of, but I pointed out to Brian Lenihan in early November 2009. In the 6 months between late 2008, when some of the banks had their year ends, not all were December year ends, but you could see that after the guarantee, which was end of September 2008, with a full government guarantee on everything in the banking system, notwithstanding that, in the 6 Irish institutions in the period from roughly January or December 08 to June 09, when everything was 100% guaranteed, when interest rates being paid on, on those deposits in the Irish banks was higher than in anywhere else, notwithstanding those two things, money out. Depositors took out 32 billion.
No, they did. They didn't actually ever believe the government guarantee, and they were, probably right.
Because the people knew that the loan losses embedded in our banks, notwithstanding the protestations of our government, their advisors, PwC, the whole lot, they said loan losses could be contained at 23 billion in the NAMA project. In fact, over 10 years, there would be 5 billion recovery, and the total loan losses in the banking system that derived from the past would only be 18 billion. That was absurd ab initio.
Can I offer Karen a thought on how a scenario for getting out of this might be?
Next question. How are we going to
3 or 4 years from now?
I'll tell
well,
you.
Can I offer a scenario on that?
Can I, just before, to be clear about the figures, because Peter, you've mentioned that the debt will be 100 billion for the banks.
The losses.
The losses at least will be 100 billion.
Does
that include the 100 billion that the ECB have given us?
It's the other side of the balance sheet.
It is,
Right,
so in fact, what the banks owe is 160 billion through the combination of the central bank.
Because the ECB is funding the losses.
But Peter believes the loss will be...
Now, what I'm saying...
Well, there isn't an exact equivalence between what you owe and losses.
No,
let's not get into that.
But let's say that's the figure we're dealing with.
I'll tell you why it can. To give an example.
Totally different to sovereign debt now.
Yes, well,
as regards losses and loans, I'll tell you how. You know you have an overdraft. You have your checkbook. You write checks worth 50,000, but not all of them have been presented to the bank. They see that your overdraft is only 75. That's the difference between losses and the amounts owed.
I think there are ways that what will happen is the following. Actually, I think something may happen on sovereign debt, because when we get to about 2014 or 13, Ireland's sovereign debt is going to be close to 120% of GDP, and Greece's will be 140, 160, God knows what. By that point, if not before, I think there's going to be a feeling that it is not possible to run a euro area comfortably with, say, 3 or 4 countries with that kind of debt-GDP ratio. And I think that what will happen, and it's actually foreseen in the EFS mechanism kicking in 2003, we will not be able to go back to the market at that point, quite possibly, although the government would like to. The IMF and the EU and the new version of the EU fund will actually give us a second loan to help us repay the amounts falling due
on the first one.
It'll be
on the first one, or on other ones coming due. It'll be a lower amount. It'll be, it'll gradually reduce the exposure.
But we need another bailout.
But we may need another bailout. And at the same time, assuming that we have not quite got to
call that in business. That's mezzanine capital.
Oh, I know.
Which means,
but this happens
halfway house between debt and equity.
This happens.
But
this
you know why, Karen?
Can I?
This is all wrong. I'm going to get it off my chest.
I was interrupted in mid-sentence.
Just 1 second now.
What will happen at the same time is that I think there will be, and this is again foreseen, there's nothing sensational about it, that the new loan, rollover loan, lower than the previous one, will be accompanied by some effort to restructure some of the sovereign
Yes,
debt, and that's explicitly envisaged to get it down below that 120%. Now that's the sovereign debt. ECB debt, this is tricky. It's very political. The ECB, as I said earlier, wants its money back, or some of its money back. Germans are especially worried about this, and Mr. Trichet is, because he presides over the central bank, and for a central bank to incur losses is very, very bad, devastating for a reputation of a central banker. I think, however, that they will not be able to get all the money back from Ireland, at least as quickly as they would like, because the assets are not worth what would be needed. Some of it is. There will be losses, and I think that will then move back into Europe, and it will become, as I call it, a public sector collective debt.
Look, what does one do in the Manley situation where there's been a big crash in the house or in the car? You admit it up front, you measure it up front, and you call in all the participants, and you affirmatively and honestly lay it out and say, the facts speak for themselves.
Well, actually, that's not typically. Here I would slightly disagree. And based on experience that I've seen in debt crisis, and actually how the IMF and the EU see these things, I think they know that down the road something like this is going to happen. But debt restructuring, and this differs, I accept, from Peter's view, is usually seen, and we may not like this, as a carrot which is given to people who've worked very hard, who've come around 3 laps of the race but can't quite make the 4th lap. I mean, this is a reality. They've proven it. And so what typically happens is that, and remember, the ink is only dry on our particular agreement for 4 or 5 months now. What would typically happen, and I think it's consistent with my scenario, is that we would do the heavy lifting on the domestic budget deficit and so on for the next 2 to 3 years, as the government is planning to do. We may not quite get the budget deficit down to exactly where we are, but we'll have shown that we've done, a very major effort, and we've tackled some of the tough problems. We get to 2013, 2014. We're not quite there in terms of the budget deficit, where we thought we would be, though we've made a big effort. Our debt is, in any event, pretty high, the 120%. The central bank debt, the European Central Bank, is still kicking around. But at that point, I think people would say Ireland, and I know this sounds patronizing, but what typically the IMF, the creditors, never do is, at the outset of this operation, say, here we're writing off 1/3.
This is very important.
We may not like that approach, but that's the reality.
Do you know why that is unsatisfactory at the moment? Sure. Because the Europeans have been fed for the last 2 years a picture that was untrue. Absolutely untrue.
The debt was not as bad
that the losses were only...
Karen,
they were told at the outset that the losses were initially 23 billion and would reduce over a period of 5 to 10 years to 18 billion. Ooh, and we know they're 100 billion. How wrong can they get? It's like, as I use the analogy, if mum and dad are away and the teenagers have borrowed the car and crashed it and all the rest, and mum and dad come home because they didn't leave the right rules for when they were away. And the car is concertinaed in the garage, but the children say, or the teenagers say, Dad, there's a little bit of a dinge on the front wing. The back door is dented, and the other one's on the hinges. Instead of saying, honestly, come in and look at the garage. It's concertinaed.
I agree with you that the numbers were, have only been, but I still would think that does not affect the conclusion I was drawing, which is that even though the numbers are now bigger than they were thought to be, I still think that the nature of debt restructurings, especially sovereign
we need leadership, and do you know where the leadership has to come in? It has to come also from the professions. The professions were asleep.